A scenario that we experience quite often is that on a yearly basis, our taxes generally change here in Guyana. Now, the problem is that we usually get the updated taxes sometime in February or March, depending on our budget and the approval of the budget. However, when these tax changes come out, we would have already run our January payroll and sometimes our February payroll and have already paid the salaries out to employees. Now, how do we handle this situation? How do we get the differences in the taxes? Techlify HR has a couple of ways that this can be done. So let's just take a look at our salaries and let's do some fixed rated salaries here. All right, so we'll see that, all right, Pat has a salary in January, and what I'll do is I'll go ahead and add another employee. So James 007, and let's say James was born sometime in 1982, and James joined on the 1st of January. All right, James is also a receiving clerk in our Essequibo finance department. So I'll go ahead and save this profile for James. Also add a salary of $150,000 for James, fixed rated monthly starting from the 1st of January as well. Now I'll hit save here, and let's go ahead and create a payroll for January just to simulate what may have happened in reality. Select 1st to 31st of January. You'll notice by default Techlify HR only loads up the employees that would have had salaries during that period, or who would have been working with working with your organization at that time. Now James isn't here, but that's because we did not select the finance department, and for simplicity, let's just remove departments altogether, and we'll create a payroll with James and Pat. Fixed rated monthly. I'll go ahead and save this. Now, of course, this payroll is using 2025 tax, which we did not have in January, so I'll go ahead and change this to our 2024 configuration, and I'll recalculate both James and Pat. Now if I go to the pay sheet here, we'll see now that this uses our 2024 tax rule. So we have 100,000 statutory deduction, and then our PAYE would have been calculated at the 40% or whatever the rates were in 2024, right? And let me go ahead and approve this payroll. Now Techlify HR has a feature that allows you to roll over. Now come February, if the tax would have changed, which it did in 2025, Techlify HR allows you to roll over the statutory balances for these employees. Now in order to do that, of course, there's a feature for that. We go to administration features, and you will see that there is a feature here, payroll taxes yearly rollover, and you want to turn that feature on, and there's an explanation here as to what exactly it does. So let's go ahead and turn that on. And what we'll do is let's go and create our February payroll. All right, so Feb 1st to Feb 28th. Again, we're using all of our departments, and let's include John here because, as we would have noticed earlier, if I go to salaries, we'll see that John has a salary from Feb 1st. So we'll include John here, and I will go ahead and hit save. Now with that feature turned on, and now we're using 2025 taxes for February, what happens is that, let's look at James as a start. Or rather, let's look at Pat. We'll see that Pat's statutory deduction is 160,000, whereas the actual statutory that's available is 130,000. But because in our January payroll, and let's take a look back at that, in our January payroll, because we were using the 2024 configuration, in 2025, Pat only got 100,000 statutory deduction. Now what happened there is that in Feb now, that balance gets added in here. So this becomes 130 plus the 30 from January. Now Pat gets 160,000 statutory deduction. The other thing that happens is that, let me show you the PAYE rate 1 and rate 2. Pat's taxes, so if we have a taxable salary of 24,000, 25% of 24,000 is about $6,100. But you see her PAYE is 3,568. And why is that so? It's because, again, if we look back at January, Pat's PAYE would have been taxed at 28%, which was the 2024 rate, or 27%, whichever it was. So she would have also paid some extra PAYE, and technically HR also takes care of subtracting that amount so that she pays less PAYE in February. Now, just having a look at James, we would see that James has a statutory deduction of 150 instead of 160, and that's because James's salary is only 150,000, so obviously he can't have 160,000 statutory deduction. Now at this point, once you would have finished your February payroll, and let's go ahead and approve that, you can then go back to the feature system and deactivate this feature if you don't want rollovers to continue, or you can leave it on. And if you leave it on, this is what happens. Now let's go even further and let's create March payroll for our fixed rated team members. Right, so I'll go from March 1st to 31st, and now we had Mana join us in March. Right, so if I go to employee salaries, we can see that Mana here had a salary for March. So our payroll our team keeps building up all the time. Now I'll go ahead and hit save. Now what you'll notice here, if we go to the pay sheet for March, is that for James, his statutory deduction is now 140,000. Now why is that so? Because he gets 130,000 by default for March, plus there was still a $10,000 balance from January that comes over to 20 went to his February, and now he has a $10,000 for March. So if you leave that rollover feature on, Techlify HR will continue to check your employee statutory deduction used for the entire year and keeps allocating any balance in statutory deductions to subsequent months. All right, and that is how our rollover feature works, and how it can be rolled over even into future months, and it affects the PAYE, both the rate 1, rate 2, and your statutory deductions, and generally any overpayments that you would have made for employees.